Today we're going to be looking at support material 11 and 12. Those are the first two chapters that we're going to be looking at, and it's looking at liabilities. So you get two types of liabilities, current and non-current. Before we look at that, just a bit of recap. You should know by now that an asset is a resource controlled by the business, arising from a past event that gives rise to future economic benefit. What type of assets can you get? Give me some examples. Cars, so vehicles, buildings. Capital that you put in is capital. Capital that you put in is not an asset. Okay, that's a separate account. Okay, yes, you can contribute an asset as capital, but there are two different things. Okay, so if I give the business furniture, I'm giving the business capital, but the furniture is still the furniture. The furniture is still the assets. Does that make sense? Okay, so an asset is a resource controlled by the entity arising from a past event that leads to future economic benefits. Assets always have debit balances because they're worth something to the business. Okay, so obviously you need to start with something, the plus. Liabilities are obligations. That's the key word. A loan would be an obligation. A mortgage would be an obligation. Creditors would be an obligation. Okay, people that we owe. What's going to happen in the future? Well, there's going to be an outflow of economic benefit, and that's going to be from a past event. So I did something in the past that leads to this outflow. For example, when I buy on credit, that's the event that gives rise to an obligation. If I buy something on credit, I'm going to have to pay my supplier in the future. So if I'm paying my supplier in the future, it's seen as an obligation today because it leads to a future outflow of economic benefits. Okay, so when looking at a liability is something that's going to be viewed as a negative from the company's point of view. Okay, and then when we look at disclosure, you'll see it's important to know what these different accounts are because then you'll know where to show the information. I want to discuss it now because we're going to look at it a bit later. Statement of financial position. Statement of financial position. That's where you would disclose information. We've discussed what financial position is before. That was the first or second week. Okay, we looked at the two rules, assets and liabilities. Okay, so now we know, if I know how much assets the company has and I compare those assets to my liabilities, I will know if the business is in a good or bad position. It'll be in a bad position if the liabilities are greater than the assets. It'll be in a good position if the assets are greater than the liabilities. We've covered property, plant, and equipment last week. We've also looked at trade and other receivables, okay, your debtors. Okay, we know that those are two different assets that can be grouped under different headings. The one is a non-current asset, meaning long-term, and the other is a short-term current assets. Okay, so let's look at timing. Property, plant, and equipment is obviously very specific. So I'm going to be looking at things like depreciation, okay, carrying value, and that'll obviously give me an estimate of the PPE's worth to the business. Trade and other receivables, we're looking at debtors. Debtors are people that buy from the business. Our perspective is always from the business's point of view. So a debtor will be viewed as an asset, okay, because the debtor owes the business. That's the key. Something else that I can add here is inventory. That's another chapter that you guys looked at not so long ago. Inventory. What is inventory? Stock that we're going to be selling. Okay, so if I'm selling stock is going to be viewed as an asset. Why? It's going to give rise to future benefits. If I sell something today, I'm going to get something more tomorrow. Okay, it could be a credit sale. That'll be debtors. Right, but the stock, if I buy stock today, I'm going to be able to sell the stock in the future. So the stock itself is also seen as an asset. Okay, and that's what you've got here. Non-current and current assets. We're going to be focusing on liabilities in these two study units. So study unit 11 and 12 are looking at liabilities. They're looking at the short term and they look at the long term. Current liabilities, you guys have seen creditors and you've also seen a bank overdraft. Okay, we did a bank reconciliation. A bank reconciliation is looking at the bank balance in the bank statement and comparing it to the business's general ledger, because our books and the bank's books need to match. If they match, then everything's good. Everything makes sense. If it doesn't match, then there's a problem. Intangibles, those are things that we can't see and touch. They can be assets, they can also be liabilities. Okay, and the reason for that is an intangible could be something that we owe or something that is owed to us, depending on the scenario. So we could have a non-current liability, which could be a loan, a mortgage, a bond, or even an intangible, okay, depending on what the focus is. Okay, you might have to, let's say, pay for a particular right. Okay, that could be seen as a liability if it's something that you're owing, okay, or something that you are obligated to do, okay, an obligation to do something. Okay, so if there's an obligation to do something, it's going to be viewed as a liability. It doesn't matter what the obligation is, okay, but the obligation would be seen as the liability. Okay, so you've studied non-current and current assets. When recording an asset, what is the accounting effect? Do you guys remember? Debit what, credit what? Think about it. You're recording an asset, so you need to increase or decrease the asset. Increase the asset. Okay, so think about buying an asset. If I buy land and buildings for the business, are the assets going to be affected? Yes. What's going to happen to the assets? They're going to increase because I'm buying land and buildings. So that would be an increase. Can I sell land and buildings? You could if you wanted to. That'll be a disposal. So if I'm looking at assets being sold, then I would credit it. Okay, so the rule is important. If I'm looking at the asset, I can either buy it using bank, cash, or I could use this, liability. And this would be seen as the financing. Okay, so we talk about financing the purchase of assets. Okay, so if I'm buying furniture, you need to finance that. You need to either use savings to buy furniture, okay, or use loans, credits. If I'm looking at buying a vehicle, same thing applies. You're going to have to finance the vehicle. You're either going to have to take out a loan or you're going to have to save up for it. If it's something else like land and buildings, same thing applies. You're probably going to have to use a liability there because that asset will be more expensive. So liability is going to help you to buy the asset, to get those resources that are controlled by the business. Notice the asset is the asset. The credit is either for bank or for a liability. So when looking at the credit, it could be for either or. It depends on how you're financing the asset. Am I using cash or am I using credit? We're going to be focusing on the liabilities, meaning external finance. Outside the business. That's what we're looking at. Okay, so I'm going to be looking at buying things or purchasing things, but using external finance, meaning other people's money. Okay, so we'll be loaning money. We'll be using creditors. Okay, is a creditor good or bad for the business? It's actually good for the business. Think about it. You can buy today and only pay tomorrow, later. Okay, does that benefit the business? It does. Okay, because think about it. If you could find someone that was willing to give you stock today and only require you to pay it back next year, good or bad? That's brilliant. Okay, you can take a year's worth of stock. You can try sell a year's worth of stock and you'll have a year to sell a year's worth of stock. And only then you're going to have to pay in the future. Okay, so that's a sustainable business. Right, so businesses need finance. They need to be able to buy assets. They need to be able to fund the operations of the business. Okay, that's why looking at liabilities are important, because they're bad because they're liabilities, but they're good in terms of finance. Okay, because they give your business time. Okay, think about it. If you can buy now and pay later, that gives you time. Okay, you don't have to take cash and give it to the supplier. You can keep the cash. You can use that to run your business, and then later you can make payments. Okay, so that's the benefit of having a liability. It's not only because it's, let's say, allowing you to buy things that maybe you can't afford. That is an advantage. Okay, because not everyone can afford to buy property, let's say. So does that mean that we don't have somewhere to stay? No. Okay, you can take out a loan to buy a property, okay, or to pay for the rent or whatever the case is. Okay, that's the liability. It's the financing part. So when looking at a liability, you get two types, non-current and current. Same thing applies, long-term and short-term. Okay, you guys know this. This is all revision. Okay, so if I'm looking at the liabilities, are all liabilities the same? Okay, you're saying no. Why? What's different about them? You're right. What's different about the liability? Okay, possibly. So the amount, the value. Okay, so how much do I loan? Okay, is that the only thing that's going to be different about a loan or liability? What else will be different? Terms and conditions, yes, the time. Okay, so do you pay back after a year? Do you pay back after a few months? Do you pay back monthly? Do you pay back weekly, daily, whatever the case is? Terms and conditions. And also, what about the most important bits? Yeah, the interest. How much does it cost you to take out the loan? That's something that you need to consider. So before we take out a loan, we need to know what the terms and conditions are. We need to know what the interest is. How much interest am I going to have to pay? So if I'm looking at a liability, what's the obligation? It's the contract. Okay, and you guys are good at doing those things, drawing up contracts, making sure the legal stuff is correct. Okay, because that's your profession. Okay, you're looking at the legal side of things. Okay, so people agreeing that they're going to pay later. Right, what are the consequences of them not paying? Well, there could be bad debts. We might have to write them off. We might have to charge them interest. So that's what you guys are looking at here. You look at liabilities. Liabilities aren't always the same because there are different factors to consider. Time, the cost. You could even look at loans that have security and loans that don't. Okay, so what's the difference between a home loan and a credit card? Is there a difference? A home loan versus a credit card. Are they different? Very different. Okay, what is the home loan financing? A house. What is the credit card financing? Could be anything. Okay, the credit card could be financing a holiday. The credit card could be financing entertainment. Okay, so are those two things different? Yes. If you can't pay off your credit card, can the bank take the holiday or the experience or the memories? No. But can the bank take the house or the property? They could. Okay, because that's a repossession. Okay, so liabilities aren't always the same. They're different depending on what you're looking at. Okay, you get long-term, you get short-term. You get liabilities that have, let's say, security and ones that don't. Okay, so a home loan has security. And that's why the bank can afford to give you a lower interest rate because the risk isn't as high. Because if you don't pay off your loan, there's still a house that can be taken and sold in order to cover the debt, okay, the loan that you took out. But with a credit card, there's nothing that can be taken. And that's the problem. So the risk is higher, and that's why the cost is normally higher as well on a credit card. Okay. Right, so when I record a liability, what's the accounting effect going to be? You've got the definition here for a liability. Credit side increase, correct. Okay, so we're going to have short-term and long-term, depending on what we're looking at. It's still going to be credited though. Why? It's a liability. That's important. Short-term meaning less than 12 months. Long-term meaning greater than 12 months. The rule will always apply. You can't change that. It doesn't matter what account you've been given. You need to know what you're dealing with. Okay, so when you see an account called creditors, what comes to mind? Liability. If you see the word debtors, what comes to mind? Assets. Because a debtor is something that you have as a benefit, because in the future, hopefully those debtors will pay us back. Okay, so if I'm focusing on the current liabilities, we spoke about short-term, that's study unit 11. If I'm looking at a short-term liability, I'm looking at less than 12 months. So if I'm looking at less than 12 months, I'm focusing on things like what? Give me some examples. There's already one here on the board. Well, kind of. Yes, purchasing merchandise on credit. What is that called? What's the liability when buying merchandise on credit? Come on, basics. Creditors. Do you agree? Merchandise purchased on credit is going to give rise to creditors. Okay, so whenever you buy goods on credit, you're always going to have a creditor because there's an obligation to pay back in the future. Right? You know, if you buy something today and you don't pay, you're going to have to pay for it in the future. Okay, there's an obligation to pay. Right? That obligation doesn't disappear. That obligation stays until you actually make payment, so meaning pay for the outstanding amounts or return the goods. Then you won't have to owe them, okay, or have to pay for it. Okay, what happens if we do not pay for an incurred expense? Incurred expense is something that we've used. Okay, so remember when we spoke about financial performance, we spoke about income is recorded when we earn it, and expenses are recorded when we incur it. Okay, so here's the question. Water and lights. Does the government bill you for water and light at the beginning of the month or at the end of the month? Why the end? Exactly. The government doesn't know how much water and electricity you've used during the month. The only time that they'll know exactly how much you've used is at the end of the month. And that's why we have an incurred expense. Incurred meaning we've used the water and electricity, but we haven't paid for it yet. Okay, when do we pay for it? Once we get confirmation. This is how much you've used. This is the rate that you have to pay. This is the total cost. Does that make sense? Okay, and that's what you're looking at here. You're looking at an accrued expense. That's actually an adjustment. Okay, an accrued expense is an adjustment. It's providing for something today that relates to the future. It's a future, let's say, payment that will take place. It's a current obligation that gives rise to a future payment. Okay, you're going to have to pay that in the future. All right, what happens if we buy merchandise on credit? Is there going to be a liability? Yes, there would. What would the liability be called? Creditors, very good. Okay, why do I call it creditors? It's because we have a credit purchase. Right? And you'll never, ever, ever have anything different. So long as the business is buying on credit, there's going to be a creditor. Okay, a creditor is someone who we've purchased goods from. What does that mean? Well, that means we we owe them. Okay, so if I buy goods from you, are you my creditor? Yes, because I'm going to have to pay you. Okay, so anyone that the business buys from is called a creditor. Current liabilities arise when there's a short-term obligation. That's the key. Now, that's why when we covered this right at the beginning, a few weeks back, I mentioned the word obligation as being the most important word. Okay, because it doesn't matter what you've been given. Right, remember, you're going to get a trial balance, and the trial balance is going to have maybe 20 different items. Okay, you're going to have to go down each item, and you're going to have to identify what is it. Is it an asset, a liability, an income, expense, capital, or drawings? If you know what something is, will you know where to disclose it? Yes. Will you know how to measure it? Yes. Okay, because certain things are measured differently. Okay, for example, inventory is measured using historical cost. You can use perpetual or periodic in terms of managing it. But when we're looking at property, plant, and equipment, there we looked at carrying value. Right, in other words, how much is the vehicle actually worth in today's terms, based on how many years you've actually used it. That's something to consider. Okay, so question here, guys. How do we measure these current liabilities? So accrued expenses, it could be the credit card, it could be bank overdraft, it could be any creditor, any liability. So if I'm looking at a credit if I'm looking at a current liability, how am I going to measure the current liability? Any ideas? Any ideas? How do we measure current liabilities? Keeping a record? What do you mean by that? You're on the right track. You're just not explaining it completely. Okay, so let's take an example. Give me an example of a current liability. One that we've looked at before. Think bank reconciliation. What current liability do you have with the bank recon? Let me ask you this. Is the bank balance always positive? No. No. What do we call a negative bank balance? A bank overdraft. Okay, because you've overdrawn. Right, so a business will have a bank account with the bank, and there may be an overdraft facility on that account. Meaning, if we withdraw more than what's in the account, I now owe the bank. The business is going to have a liability. Does that make sense? Okay, so how do we measure that bank overdraft? What are we going to be looking at? How will you know if the business has a bank overdraft or not? Exactly, by looking at the bank statement. And what balance are you going to be looking at? The one at the beginning or the one at the end? Good, the one at the end. And the reason for that is it's telling you what the current liability is today. Okay, now, at a moment in time. Okay, because remember when we covered the basics, financial position, all the way back, we spoke about position being at a moment in time. So if I'm looking at the current liability, do you agree? If you've got a loan, is the loan balance going to stay the same? No. The loan balance will either go up if you're not paying off the loan, it'll be charged interest, or the loan account will be coming down if you're making a payment every month. Okay, so what am I going to use to measure the current liability? Current value, I'm going to look at realizable value, cost. There could be different things. Okay, I'm looking at value in terms of what is it worth today. So if I take out the loan today, I could maybe use the inverted commas, the cost. Okay, so how much did it cost me to take out the loan? That's going to be the value of that particular liability. But ask me 2, 3, 4, 5, 6 years down the line. what's the value of the loan? The answer is probably going to be lower if you're paying it off. So then you'll be looking at what? The current value. Okay, or realizable, meaning what you can realize. Okay, what's the current value? It's almost like carrying value. Okay, we spoke about property, plant, and equipment. Let's relate this to something you know before. Okay, PPE, how do I measure PPE? Carrying value, do you agree? What is carrying value? Cost minus accumulated depreciation. Okay, that's something that's used to measure the value of the assets, okay, the PPE. Here, I'm using the current value, meaning today. Okay, how much do I owe on my loan? How much do I owe the bank on my overdraft? How much do I owe, fill in the blank, okay, the liability, right? And that's what you're looking at. Okay, so always remember that liabilities and assets are viewed at a moment in time. That's key. Because when you get questions, you need to know, what am I dealing with? Am I dealing with the asset, the liability, the income, the expense, the capital, the drawings? Okay, so here's your financial position. This is what it looks like. Okay, we're going to do our first example later on. Okay, I'm going to show you disclosure. Okay, we'll do lots more later on once we've covered all the theory. Obviously, I want to try use some of the past paper questions as practice, so at least then we're killing two birds with one stone. Okay, I do encourage you guys to go back into your study guide and to try look at some of those exercises. Okay, I'll mention one or two now today because they're quite good. The current liability exercises in the study guide are actually quite good because they give you lots of different journals to consider, and we've covered journals. We know that journals record transactions, right? But now you've been given a total from the journal, and now you need to post it to the correct account. Okay, and that can be difficult if you don't know your basics. Okay, so for now, just appreciate what the format looks like. When you have a statement of financial position, you'll have two different sections. This section is looking at equity and liability. That's not the only section. Okay, remember companies also have assets as well. Okay, and the difference between your assets and liabilities actually gives you your owner's equity. Okay, so if I'm looking at the statement of financial position, I'm going to be focusing on two things. Disclosure, so where do I put information, and what am I going to be disclosing? What's the amount? What's the net amount? Okay, so when I look at non-current liabilities, I'm going to be looking at things like a mortgage. That could go there. Non-current, okay, long-term. If I'm looking at current, I'd be looking at something like creditors, trade payables. I could be looking at something like accrued expenses. Doesn't matter what you're looking at. But you're looking at timing, meaning less than 12 months or within 12 months or greater than 12 months. If it's greater than 12 months, it's long-term, then it's non-current. If it's less than 12 months, it's short-term, then it's current. Makes sense? Okay, so again, I've tried to use both the textbook and the study guide just to give you guys some examples. Okay, so have a look at them and just appreciate what they look like for now. Okay, we're going to get there where we actually create them. Alright, so this is just a little bit about your basics. In the statement of financial position, what must the equity and liabilities equal? We just spoke about it. Your assets, right? Correct. Okay, and earlier we spoke about that as well. Okay, remember earlier you saw a page where we spoke about the liability financing the assets. Okay, if I buy an asset, it's going to affect cash or the liability. If it affects the liability, I'm using debt. I'm using a loan. I'm owing someone something. Okay. Let's check your basics. Do you still know what accounting elements are going to be affected? In the purchaser's journal, what am I going to debit? What am I going to credit? Any idea? Debit what, credit what? income. Think about it, purchaser's journal, purchases. If you're purchasing and it's on credit, what's going to happen to your creditors? Increase or decrease? Why increase? Because you're buying in credit. So am I going to now have a creditor? Yes. Before, did I have a creditor? No. Okay, so I didn't have a creditor before. Now I have a creditor. Am I going to record that in my books? Yes. Are you increasing the liability? Yes. Then look at your rules. Where does the liability increase? On the credit side, exactly. Okay, and that's what you would have for your purchaser's journal. Right, and that's important because the journals need to be recorded in the ledger. And if you don't know what's happening in each of the journals, you're not going to be able to post it to the ledger. Okay, because I'm taking totals. Right, what's going to happen in the purchaser's returns journal? What elements would be affected here? Creditors will decrease. Where do they decrease? Why do they decrease on the debit side? It's seen as a liability. Do you owe more? Do you owe less? You owe less when you return. Okay, and that's why you take it off the returns. Okay, you're showing less. You're not showing more. Okay, and there's your workings. Debit the creditors, credit the asset or the expense, depending on what you're actually buying. What are you paying for? Okay, there is a special account in the cash payments journal that relates to the creditors. Do you know what it is? Well, let's start easy. If I make a credit purchase, what did we say we're going to debit and credit? We just saw it not so long ago. If I'm purchasing something on credit, what am I going to debit? The item that I'm buying on credit. Good. And what am I going to credit? The creditors. Perfect. Okay. If I have the purchase, am I going to pay at some point in time in the future? Yes. So the special account is discount received. Okay, can you have a discount that's received from a debtor? Would you receive discounts from your debtor? No, you wouldn't. What discounts would you have with the debtor? Discount allowed, discount given. Good, discount granted, good. Okay, so those are discounts that relate to debtors. This is the discount that relates to creditors. Where will you see it? It'll probably be in the cash payments journal. If it's not there, it'll be in the general journal. Okay, general journal can record anything. We did do that not so long ago, correct. Okay. Right, a cash payment for creditors has this effect. Okay, so now give me the basic transaction. If I'm paying my creditor, what am I going to do to my creditors? I'm going to decrease my creditor. If I'm paying, what other account will be affected? Bank, good. Okay, you make payments from the bank. So what's going to happen to the bank account if I'm paying? It's going to decrease. So am I going to debit or credit bank? Credit bank. Am I going to debit or credit the creditors? Debit, because the creditors are coming down. Good. Right, so now if I've got that scenario happening, can I get a discount from my supplier? Possibly. And if you get a discount, let's say the discount's 5%, you're then going to only end up paying 95%. Okay, so notice how you've reduced your creditors and you've reduced your bank. But there's a benefit that I receive here in the form of income, because I made use of the discount, so I didn't end up paying the full purchase price for that particular asset. Okay, make sure you've got that down. Some of these slides I've left it out on purpose so you guys can think about the actual transaction. What type of account is discount received? It's income. If you're getting a discount, is that good? It is good. Okay, that's why it meets the definition of income. It's an increase in economic benefit. That's the key. Right, happy with that? Got what you need? Okay, next bit. Other current liabilities, we spoke about a few earlier. I've tried to give you a bit of a list here. The one that you guys are familiar with, output VAT. What is output VAT? It's a liability. Why is output VAT a liability? Who can explain why? Why is output VAT considered a liability? Picture the diagram. In and out. Goods coming in is called a sale, right? Okay, so if you've sold something and there's VAT on the sale, are you entitled to it? No. What VAT would that be called? Input or output? It's going to be called output VAT. It's not input, right? Okay, because goods are going out if I'm selling. So every time you sell, there could be a VAT implication, so long as you're a VAT registered business. Other things, borrowings or loans, accrued expenses, net income received in advance, provisions. These are other non-current liabilities. All of these accounts will have what type of balance? Debit or credit? Debit or credit? Credit, perfect. And the reason for that is? It's a liability. And liabilities have to follow the rule. Plus on the credits. Got that? Perfect. Okay, now we're going to change focus slightly. It's still liabilities. That's why 11 and 12 link. Okay, because the one is looking at long term, the one is looking at short term. Both are loans. Both are liabilities. Okay, so we spoke about the obligation. We know that's the key word. What differentiates a long-term asset, a long-term loan from a short-term loan? I kind of gave you the answer by saying asset. What do we do with long-term loans? Yeah, what do they do? What do they do? What am I going to use a long-term loan for? Buying land, correct. Okay, so here's the question. Are you going to take out a 20-year loan to pay for your groceries? Why not? It's not a long-term asset. It's not even an asset. It's an expense. Okay, but you're going to be paying for those groceries over 20 years if that was a 20-year loan. Is that good financial management? Definitely not. Okay, but if I took a 20-year loan to buy property, see, that's different. Okay, because now the financing is key, the benefit. Because you know that if you take out a loan, you're going to have to pay more in the future. Okay, so obviously the business needs to generate sufficient value or, let's say, profit in order to pay for the outstanding liabilities. That's the key. Okay, so obligations arise from liabilities. Okay, if companies don't pay, that's called insolvency, bankruptcy. Do companies want to go bankrupt? Definitely not. Okay, so liability should be lower than our assets. Okay, if the liabilities are lower than the assets, that's a good position to be in. If we're not, then we're either insolvent or we're bankrupt, or sometimes they talk about like technical bankruptcy, being technically insolvent, meaning on paper your assets don't exceed your liability. So technically, you're insolvent unless your cash flow can still maintain the business. Okay, not a going concern. Companies that don't continue operating. If I go bankrupt, that company ends. You need to write off the company. Okay, it's insolvent. It's something that has occurred that negatively affects the business. Okay, so I want you guys to debate which type of credit is better. Okay, so you decide which side of this debate are you sitting on. Are you the one that's sitting on the left, or are you sitting on the one on the right? Is there a better type of credit? Meaning, is long-term better than short-term? Is non-current better than current? We need to discuss. Okay, so what points do you have regarding debt, regarding non-current liabilities? What can you tell me about what you know about these liabilities? Come, give me characteristics. Tell me which do you think is better? Okay, so that's something you could consider time. Is the time the same? Definitely not. Current liabilities will have a shorter time period. Long-term, non-current liabilities will have a longer time period. What else will be different besides the time? The amount. So which would you say is generally bigger? Correct, the long-term. Those loans that you're taking out for long-term assets are going to be a lot bigger than the short-term small loans. Okay, what else can you think of? We spoke about collateral in terms of security or no security. So which one has security? No, looking from the business perspective, taking out a loan. Yes. And? Think about it. Did we say those loans are good or bad? We said they're better. Why? Because you're financing or buying maybe property. Okay, so let me ask you this. If I take out more debt to buy property, good or bad idea? It's not a bad idea, okay? It might not be a good idea depending on what the market looks like, okay, but it's better than spending money on the credit card. Do you agree? On entertainment. Stuff that doesn't last. Okay, material objects. Okay, material objects are just enjoyed, okay, by the consumer. Okay, so we buy certain items because of enjoyment. Okay, we like the taste of that particular item of food. Okay, we like a specific item of clothing. Okay, we like a specific brand of stationery or vehicle, or it could be anything. Right, but because you have that, you're going to be looking at paying that over the short term. Okay, so if I'm buying food, I'm not going to use the home loan to buy food. Do you agree? Okay, because that's day to day. You'd be using creditors maybe to buy food. You'd be using the bank overdraft perhaps to buy food, if that's the case, if there aren't any savings on hand. Okay, so there's quite a lot here. I've spoken about collateral. The word collateral means the house for the home loan, right? So the house is an item of value that's seen as security for a loan. Okay, so is someone going to be more or less comfortable giving you loans if they don't have a track record? If I'm taking out a loan, would the business want more or less information? Exactly. The business will want to know more information. Why? To avoid? Possibly. Or? Hey? Cancelling out the debt. What do you mean by cancelling out your debts? You're going to get blacklisted. Okay, so when looking at non-current and current, which do you think is better? Do you guys have a specific preference? Do you like the one more than the other? Okay, well, debt is dangerous because debt creates more risk. Okay, because the keyword was obligation. Okay, do people want lots of obligations? No, because it creates more risk, it creates more problems in a way. Okay, so those problems need to be managed and they need to be fixed. Okay, so if I'm looking at better form of finance, it all depends on what is your goal. Okay, so if I'm going to be buying land and buildings, would I go non-current or current? I'll go non-current. If I'm looking at buying stock, would I go non-current or current? I'd probably go current. Okay, buying stock and then paying for it in the future. Okay. Is there a better type? No, there isn't. It's about managing the credits. Okay, and obviously it's quite interesting that, so for example, we're talking about credit. We know credit is going to be a liability. Do you agree? Okay. Do businesses talk about credit or do they call it something different? They talk about credit, right? Okay, so if you go apply for a loan, they're going to say, this is your credit application or your loan application. Do you agree? Okay, do they replace this word credit with this word? Debt. No, they don't. Okay, so come to our business and we'll give you a credit account. Do you agree? Or open a credit account with our business. Are you needing credits? Okay. The actual thing from our perspective is what? It's debt. Okay, so do you want another debt card? Okay, that's basically what a credit card is. Right, it's going to put you in debt if you don't manage it. See, that's the key. It's about managing your credit. That's the important bit. Okay, because earlier we said we can use credit for good things. Buying property, buying machinery, buying things that we can use to make more profits. Okay, if we're looking at a business. Okay, so credit is very important. A credit account is a loan account. People don't call it a debt account. Do you agree? But that's actually what it is because our perspective is different. We're looking at things from the business's perspective and we're viewing the creditors. We're viewing the credit transactions. Okay, the payments. Right, so can you get long-term and short-term? Definitely. Long-term obligations with bad consequences if these obligations are not met. Okay, so what are we going to call that? Bad debts. Do you agree? Things that we're going to write off. Counting recognition of liabilities once a what occurs. So when do I record a liability? Good. When the obligation is established. Perfect. Okay, so if you have an obligation, there's no question about it. It's a liability. Okay, obligation to pay, an obligation to do something. Right, the recognition measurement we spoke about earlier when we looked at current liabilities. Is that going to be the same for non-current? Yes, it would. Okay, so with non-current liabilities, you're also going to have the value of the liability, okay, be it the loan, be it whatever the case might be, and you'll have a value, meaning how much it is actually worth. Okay, so when I have a transaction that looks like this, what is this transaction doing? How would you describe it? Good or bad? bad because I'm creating a liability and I'm buying maybe an expense. If it was an asset, that's not so bad. Okay, because I'm financing an amount that I'm going to be using in the future. Does that make sense? Okay, so depending on what you're financing, you can either use long-term or you can use short-term finance. Okay, are there liabilities? Yes, they are. The liabilities will either be used to buy or pay for expenses, or they'll go towards assets. Okay, as a business, you would want to allocate as much of your liability towards an asset as possible, because in the worst case scenario, you can still sell the asset and try pay off the liability. Does that make sense? Okay, what value do we have? Same thing as before. Cost, realizable, current value. That's what I use to measure non-current assets at their current value. Okay, what we currently have in the question. Okay. Right, then just a short note here about borrowing and mortgages. Are these liabilities important? Yes, they are. Why? Why do you think they're important? It's where they're allocating or using the finance. Okay, so are these liabilities important? Yes, because they're going to be used to create what? Value. Okay, so buying land, buying a building. If I've got something, it's value. It's important because of capacity. Okay, financing assets, there's it. Okay, so how much do you have? Do you have sufficient to keep running the business? Yes or no? It all depends. Okay, remember, businesses use liabilities to help finance the business. That's key. Okay, this is actually moving more towards finance. Okay, but because remember, all the fin modules, it doesn't matter what year you are, they all require FAC1501 as a prerequisite. Okay, the reason for that is you need to interpret the information. Okay, you need to know what a liability is. You need to know what an asset is. Okay, you can't make decisions if you don't know what those things are. Okay. Right, disclosure is key. Everything needs to be disclosed. So you'd put things like the financial instruments, the interest rates, the due dates, etc. Okay, it's detail. Right, the textbook does talk about debentures. Have any of you heard of the word debenture before today? No. Okay, so a debenture is similar to a share. Do you guys all know what shares are? Okay, it's a portion of the business. Okay, so if I'm a company, I would own shares in the company. Okay, well, if it's the company would have shares that other people would own. Okay, you would sell shares to an investor. Okay, someone who's willing to buy into that particular asset. Okay, so if I'm looking at a portion of debt, if I have 100 Rand per debenture, let me ask you this. Let's say you wanted to raise 100 million, okay, to build a building. Easy or difficult to borrow 100 million? Difficult. Why? Because it's a big amount. Okay, so if you want to build a building, you're going to have to approach investors. All right, that's quite a difficult task to find one investor that's going to be willing to give you 100 million. Do you think we would be able to find 100 investors giving us each $1 million? Okay, that's probably easier. Right, it'll probably be easier to find more investors investing a smaller amount than one investor investing a massive amount. Okay, it might not always be the case. Sometimes banks would be willing to give you the full 100 if there's a benefit of granting that loan. Okay, depending on what you're doing with it as well. Okay, so a debenture is exactly that. It's a portion of debt that's broken up into different units. It's like taking 100 million and break it into 100 million loans. That's what it is. Okay, so it's taking 100 million in total and break it up into 100 1 million Rand loans. That's what you're doing. Okay, so with any non-current liabilities, disclosure important? Always. Okay, and that's why I've put a note here about the textbook. Again, the textbook is a nice additional resource that covers more theory. Okay, they talk about other ways of disclosing information, making the information more accurate. Okay, better for the user. Right, I think that's it for here. Oh, just a question here. How many units are there? Forgot to discuss this. If you hold 200,000 debentures and each debenture is worth 100, how many debentures would you have? You'd have 200 units. Okay, I haven't really seen this come up. It's just something to consider, okay, when looking at non-current assets and liabilities. I'm looking at both. Okay, you'd have to buy a non-current asset with a non-current liability. That's the best, let's say, decision. Okay, finance things with the right finance. Okay, so if you want something long-term, finance it with long-term capital. If you want something short-term, finance it with short-term capital. Okay, because then you're not tied in and things don't become too problematic. Okay, then I've just put a note here at the bottom. Statement of comprehensive income is where I show interest and financing costs. Why do I show that there? What is the statement of comprehensive income telling me about the business? How much income? Almost. How much profit? Okay, so the disclosure is specific to the business. And if I'm looking at the statement of comprehensive income, you're looking at how much do I owe, or, owe, you could use that, or how much I've paid. How much I've paid or how much I owe during the 12 months. Okay, that's why you're looking at interest as being a financing cost, okay, as part of the statement of comprehensive income. Anything that happens in terms of operations must be recorded in those books. Okay, statement of financial position, its notes, its detail. We need to show our debentures there. We need to disclose it to our users. Okay, and this is just an additional example that comes out of the textbook. Okay, the textbook talks about these debentures. They tell you that there's non-current, total of 25,000, okay, of 100 Rand debentures. Okay, so if I times that, I'm going to get 2.5 million. Okay, minus the short term, which is, why do I take out short term? Because I want non-current, and non-current is long term. Okay, so if UNISA gives you a total liabilities, if I wanted current, I would have to take out the non-current. If I wanted non-current, then I'd have to take out the current, because then you'll be left with the liabilities that you have at the end. Okay. Right, they do talk about the interest. Just make sure you can calculate interest. If I'm working out 12% on 2.5 million, how do I do that? I take 2.5 million, I times that by 12%. Okay, this was a portion of the year. You would times it by pro rata. Okay, number of months over the total. Okay, this was a separate consideration in terms of the current. Okay, the loans that we take out. Okay, so if I'm taking out a loan, I'm going to have to record it in my books. Okay, so I'm going to go to your study guide just to show you what I mean by this. There's the study guide. Okay, exercise 3 on page 195. Okay, so I want you to quickly go down this list, and I want you to tell me, are any of these accounts going to affect my accounting records for the business? And I'm going to be looking at liabilities. So would any of these accounts affect my liabilities? That's the key. Okay, that's what I want you guys to quickly do. Okay, so go down the list. Okay, so let's look at each of these. Balance of the creditor's control account. What is the balance? It's what you're starting with, right? Okay, so what was this? Was this for the beginning or end of the month? Beginning of the month. Beginning of January is end of May. Do you agree? Okay, so if I'm looking at creditors, what type of account am I dealing with? An asset, liability, income, expense, capital drawings. liability. So what balance will you have here? Credit balance. Okay, so the credit balance is going to be what I'm going to be recording in the actual T account for my creditors control. Okay, and that's the approach that you need to take, is looking at what is the actual account. All right, and then post to your creditors control. Okay, so obviously I'm going to have this amount as a credit, 571. Okay, cash payments journal. Does my payments affect my creditors? Yes or no? Yes, it will. How will your payments affect your creditors? It would decrease it. Where does the liability decrease? On the debit side, exactly. Good. Okay, so you would show the bank and the discounts on the debit side of that particular account. Okay. Purchasers journal. Does the purchasers journal affect your creditors? Yes. How will it affect your creditors? It would increase it. Good. Okay, so purchases would increase your liability. So that's going to go on the credit side. Purchases. Okay, will a return affect your creditors? Yes, it would. Would it increase or decrease it? It would decrease it. Good. So here you'll have purchases, returns. Okay, purchases, returns. Is that right? Okay. General journal. Certain accounts with debit balances transferred to trade receivables ledger from trade payables ledger. Idea? Any idea? Is this going to affect our creditors? Yes. Okay, what is this saying? This is saying that some of our creditors have debit balances. Okay, when will a creditor have a debit balance? Is it possible? It is. When what happens? No. When you're paying them. Okay, exactly. If you pay them too much, then you'll have a debit balance on your creditor. Okay, so you can have debit balance for creditors and credit balance for debtors, but it's very unusual. Okay, it's not often seen. Right, and then obviously they talk about invoices that needed to be corrected here. The main purpose of this is the journals, posting the journals to the T account. Okay, you've got the solution here, so you can see there's the balance. There's the purchases. Okay, I see they've disclosed it as net over here. You can show it separately, it doesn't matter. Okay, returns, and then you've got balance brought down, balance carried down. Right, obviously bank is the amount that I actually pay. Okay, if there's no discount, then I wouldn't record anything. Okay, what discount could come here if I had a discount? What discount could arise with the creditor? Discount allowed or received? Good. And if you're receiving a discount, will that increase or decrease your creditors? It would decrease it. Good. So you could see a discount that's received here. It's possible. Okay.